Now, I just want to take a bit of time just to differentiate between private loans and joint ventures because they are different. You might be thinking, okay, this sounds good. When do I do a loan and when do I do a joint venture? Whereas if you're quietly doing things alone, you might be the best kept secret, but no one's going to come and lend any money to you if they don't know what you're doing. We're going to talk about some of the different ways of financing deals. So I think if you have your own funds, you've got savings in a bank or if you've got equity, I think it's a good idea to use your own money first because then that's a great way to, especially if you're new, a great way for you to gain track record and kind of demonstrate what you're doing. Or if you have literally no funds at all, strategies such as rent to rent. Many of our students have started with the rent to rent to get cash flow coming in, and also they can take investors, show them around the property, say, look, this isn't my property, I don't own it, but I'm managing it, here's the money I'm making, to demonstrate you know what you're doing, and that might give people confidence that they might want to work with you. As I've said many times, I just want to say it again, make sure you know how to find great deals in the first place, because if it's a really good deal, there's going to be enough margin in there for you to pay a good interest rate to someone and still have plenty of profit for you. Just on this, so profitable deals, you've got capacity to obviously share some of the profit. Now, there are different ways you could do that. You can share as a private loan where you're paying just someone interest, or you can do it as a joint venture. And it's really good to start with joint ventures because it's a way to build confidence and someone's putting the money in, you find the deal. But I think really, if you want to be more successful, you want to progress onto private loans. I'll talk a lot more about that probably tomorrow. But really, you know, it's a good way to start. But don't get stuck just doing joint ventures because joint ventures can be pretty expensive. Now, I just want to take a bit of time just to differentiate between private loans and joint ventures because they are different. And many people kind of get them mixed up. So I want to make sure, certainly within our group, we are using the same terminology. I often see people or hear people saying, I need to get some JV finance. What they actually mean is they want to get a private loan. So just to be clear, let's have some definitions here. So a private loan, that's when you borrow money from someone to fund a purchase, a deal, and you pay them a fixed rate of return. So whatever that is, you agree with them, and it's for a set amount of a time. You know, normally you have a project, it's going to take a period of time. Bit of a tip here, if possible, request the money for longer than you need it. The thing is, things always take longer than expected in property. You have delays which may not be your fault at all, and so try and arrange for the loan longer than you need it and make sure you can pay it back early if required. And then the whole point with the loan is that they get their interest plus the capital back before you make any profit. So in theory, they've kind of got the first call on the profits. There is always a risk with any loan you make. However, someone making a loan to you is maybe less risk than a joint venture. Remember, you're not in business together. It's a simple loan transaction you're doing. And generally, it's a shorter term arrangement. It might be a 6-month or maybe a year. I mean, it can be many, many years, but generally it's a shorter term. People might start off by doing a loan with you for a short period of time. And if it goes well, when you give them money back, they say, well, actually, I don't really want it back. Do you want to keep it for longer? That happens all the time. And sometimes they come back with more money the second time because they've tested you out, you've done what you said, and now, yep, they're happy to lend you more cash. So just that's a loan. I want to be really clear about that. JV is slightly different. JV is where you're working with someone, but you've got a share of the rewards and a share of the risks. Whereas a loan, there's always risk, but you're taking on more risk because the person who does the loan is going to get their money back plus interest first of all. Typically, you've got the deal and they bring the money in. Now, it might be you're watching this thinking, well, I've got lots of money, but I don't have people I don't have the deals. So maybe you want to be funding them, but you'd put all the cash in and the other person would find the deal and do all of the work. It's very important to make sure that when you have a joint venture partner, that the other side is fit for purpose. So in other words, if someone says, yeah, I'm going to put all the money in, have they got enough money to fund it? What happens if you run out of money halfway through? Likewise, the person who finds the deal, if they say, hey, I'm going to do the deal and project manage it all, have they actually got the skill and experience to actually do that properly for you? Now, there are many different ways that you can slice and dice a JV. It can be whatever you and the partner want it to be, but the typical classic model is a 50-50 deal where the one party puts in the property deal, the one party puts in the money, so they're bringing resources to the party, and they then split 50-50 the cash flow and the equity growth from that property. That's a very simple, very common model. It doesn't have to be 50-50, but that's often the way most people do it. And the point here is that you both make money at the same time. If the project makes money, you both make money. If the project loses money, you both lose money. Okay, really important. And it's generally going to be a longer term relationship. You might buy something and flip it and sell it on. Well, okay, maybe that's not going to be too long, but generally you're going to hold property, which might be 5 or even 10 years. So it's really important to get to know your joint venture partners very well to make sure they're the right people for you. I've done some JVs that have been fantastic. I've done some JVs which, to be honest, haven't been so good. And you know, it's better to learn from my mistakes and other people's mistakes rather than making them yourself. So you might be thinking, okay, this sounds good. When do I do a loan and when do I do a joint venture? Now, when you first speak to people about working with some of their money and explaining what you're doing, you will no doubt have some people who say, well, that's really good. I like what you're doing and I've got some money to put in, but really I want some of the profit. I want some of the equity. I want a piece of the action. I don't just want to get a loan. They might want cash flow or equity or both of those rather than just getting interest. However, they may not realize that a JV is also a share of the risk. You start saying, well, we can do that if you want, but just to realize that there are some risks with any project and obviously you have to share those risks with me. And what you might do is suggest that, well, why don't we do this? Why don't we do a loan first of all, where we just get to know each other and make sure we're happy working with each other, and you're going to get your money back plus interest before I make a single penny in profit. And if that works fine, as we expect it will, then maybe we can go into a joint venture. And I think that's actually a genuinely good way of doing it, because you can really get to work out, do you really want to be in business with this other person, which is effectively what you're doing if you are in a joint venture. Now, I have a belief here. I see a lot of people who give away too much of their profit by doing a joint venture on a deal where actually they can recycle all of it. So maybe you've got a great deal, they bring the money in, you're buying below market value, you're adding value. Very soon, 6 months down the line, it's 9 months, you can refinance, take all of the money out. So if you're then giving all of that money back to the joint venture partner, and yet they're going to get 50% of cash flow, 50% equity for however long you own it, that's actually very, very expensive. And so we're going to come back to that, I think, tomorrow, just to really quantify that for you. So I'm not saying don't do joint ventures. They can be great in some circumstances, but don't get stuck just doing joint ventures. To be a more successful investor, you want to progress on to doing private loans, which many people think are harder to get because, well, I'm not giving away as much. But it's all about how you position it. And again, we're going to help you with your thinking about that tomorrow afternoon. For you to be able to do deals, to do joint ventures, to do loans, you have to be known. I went to an event last November in Birmingham at the NEC. It was an event with lots of speakers, and Grant Cardone was speaking. Now, I know Grant. I've spoken on a stage with him at another event, and he was speaking. So I went along to see him and see his wife as well. And he came on stage, and his whole hour presentation was all about how you have to be known. He said, if you want people to work with you, they have to be aware of you and they have to want to work with you. Whereas if you're quietly doing things alone, you might be the best kept secret, but no one's going to come and lend any money to you if they don't know what you're doing. And Grant went on to explain how, and by the way, in case you don't know, he's a very successful American entrepreneur. He's been a sales trainer. He was working in the car industry, then making money from that, putting it into property. And now he's a very big property investor and property and sales trainer. And he explained that about 11 years ago, he started posting a lot on Facebook and Instagram. This when Instagram only kind of was just coming out, and some of his friends said, what are you doing that for? What are you wasting your time there? You know, that's for kids, isn't it? And he did it consistently for 11 years, such that he now has millions and millions of followers on his Instagram and on his Facebook. And the reason he mentioned this was last year, so in 2019, he raised $300 million. Let me say that again, $300 million just through his Facebook and Instagram account. So he had no brokers. He just said, hey, look, I'm looking for some more money into Cardone Capital, which is his big investment fund. $300 million just came from his social media. Now, I'm not suggesting that you're going to be able to do that, but guess what? People need to know what you're doing. They need to know that you are actively investing in property, because you might be a doctor, you might be a teacher, an airline pilot, an engineer, whatever you are. That's what people know you as, because that's what you've been for many, many years. And especially if you're new to property, or you've only got one or two, you need to let people know that you are investing in property. You need to raise your profile, and that sometimes means you're stepping outside of your comfort zone, because people get embarrassed. And one of the reasons people don't like to post is, say, well, what if my family or friends kind of take the mickey out of me because, well, what do you know about property investing? Or what if I say I'm going to do all these great things and I don't do it, I'm going to look like an idiot. And very often we're worried about what people might think about us. And we're going to talk about that tomorrow, because that can really stop you from moving forward. But you know, it's never ever been easier than right now to raise your profile. You know, I've been teaching people for 17 years how to be successful investors. We've got loads of very, very successful students. We've got a great track record of what people have achieved. And yet there are some people who might have only been investing themselves for 3 or 4 years, and they've only been teaching people for 1 or 2 years, but they can become just as well known as me because they're using social media really well. So in the same way, there might be people who've been investing 20 years who maybe aren't that good at social media because they haven't had to. And you might come along as a new investor, you can raise your profile and appear more investable than even someone who's been doing it a long time. Again, this might be challenging some of the beliefs in your mind, but that's exactly what I want to do. And so through social media, you can create and raise your credibility and attract people to you who might want to work with you. But it starts all with being known, and we'll talk more about that. I do hope you enjoyed watching this video. If you enjoyed it, I highly recommend some live online training that we're doing. All you have to do is click on the link below to get full details. And the great thing about live training is obviously we can interact, you can ask me questions, and we can answer them live in the moment. So come and click on that live online training. I look forward to you very soon. In the meantime, I've lined up another video I think you're going to find very useful. So invest with knowledge, invest with skill.